So I know the fact that we've got two, it's like two final exams is what it kind of seems like. It's not really. Those comprehensive assessment exams, which you have in every class now, is an exam that is administered by the department as a whole, so the whole accounting department, and that exam is given to every student taking that particular class. So whereas, if somebody else is teaching payroll accounting, they might give a different final exam than I do. It's up to that professor. But this particular, the comprehensive exam, is to make sure that you have an understanding of the competencies for the course. I don't know if you guys are aware of the competencies for the course. They are online, but there's a list of things that say that we cover in the course. So that comprehensive exam is it's required of everybody, and it does have to be proctored, meaning it's got to be in front of either taken using proctoring software or taken at the testing center or in class. So somebody has to observe you while you're taking that exam. It's a shorter exam than the final. If I remember, it's like 30 questions. They're all multiple choice or true false. I think mostly multiple choice. And they're kind of at they're very basic. Like they're very much overview type questions. Okay, so you don't, and we'll go through some of the details of what to expect for that particular exam. But we are going to have that in class then on the 27th there, 60 minutes. It is worth, it does count toward your grade. Okay, some professors have it count toward their grades, towards students' grades, some don't. Some offer it as extra credit, even though it is required. In this class, it is part of your grade because I want you to try. I want you to put effort forth on it. So it is worth 50 points. But that is going to be, so our last class meeting, that's what we're going to do is take that exam. Now, the final chapter 6, homework assignments and the assessment. So this is the only week where we're going to have the assignments and the assessment due at the same time. You kind of have a lot coming up. You've got 2 exams, and then you've got, all the homework as well. So just be prepared that you've got quite a few things that are due. So those are both due by the 2nd of May. The final exam is also due by the 2nd of May. That is going to be a take-home final that you'll be able to do. You do get to you open book, open notes. Okay, so you get to it does cover all 6 chapters though.
So there's no proctor?
No, not for the final exam. Just that comprehensive assessment exam. I know the terminology. I know.
In the composite assessment, can I have like a one sheet of?
Yes, you're allowed 1 sheet of notes, just like we did with the midterm. 1 sheet of notes front and back.
And it covers 1 to 6. Or?
It covers. Yep, it does. Like I said, we'll go over. And I think I've got a review folder up for that as well. That kind of gives you an idea of the things that are covered. But when we go through it in class, I'll give you more, get you more focused information on that. Okay, and then you're done. Anybody taking summer classes, registered for summer classes? Yeah? Okay, so, and you've already registered?
Yeah.
Oh,
the second payroll.
Oh, okay, cool. Very good. So the fall schedule just went live as well. So it just came up. So if you're planning on taking any classes in the fall, you might want to take a look at that. I think it's honors students and military students are allowed a week's head start. And then returning students register after that, and then they open it up to new students. So, but that is up there online. Okay. Any questions on schedule or anything else? No? You guys all look really excited to be here today.
And have you tried the Canvas software?
Oh, the Canvas software. Yeah, that so that starts in the fall. Canvas. The instructors are still learning how to use it, and we've got to get our courses all updated. But I know they've got like distance learning, or whatever department is in charge of that. We'll have tutorials and stuff like that. But yeah, so for the summer, we're still using Blackboard. But for starting in the fall, we're going to be using Canvas. So it'll be fun. You know what my summer is going to look like is getting all my classes updated to Canvas. All right. Any other questions? Okay. Oh yeah, go ahead, Tammy.
Do we need to let you know if we're going to a testing center or if we're using the software for that comprehensive test?
If you want to go to a testing center, let me know, because I have to send them the test, and I've got to send them your information and all of that. So yes, please let me know. And you can do it once we get closer to that time as well. Other questions? Oh yeah, Lisa, go ahead.
Sorry, right at the beginning of class, I wanted to verify something else and my computer went kaput, so I had to get a different computer. The Chapter 4 assessment test is due today, correct? Not like Thursday, but today.
The homework is due today.
Homework is due today, okay.
So the assessment isn't due until next Tuesday.
Oh.
Yep, so homework's due tonight. Assessment isn't due until next Tuesday. So unless you're ready to prepare it, to do it, don't start it, because that one is timed. And you got 2 hours.
No,
Okay.
for some reason I had Tuesday in my mind, so I'm thinking, oh, wait a minute, and it just hit me today. Wait a minute, I got both of them today, but no. Okay, so it's next
Right.
Tuesday.
That's all right. Well, you thought it was Wednesday too, so.
Yeah, I did.
Right?
I told you I don't know what day it is.
I get my days messed up all the time.
All right, thank
Yeah,
you.
so you're
Oh.
welcome. Any other questions? Okay, let's continue on talking about unemployment tax. Let's see. And naturally, it's not going to go to the slide I was on. All right, I think this is where we left off. So FUTA, just like wages that are subject to federal income taxes and wages that are subject to Social Security and Medicare taxes, we have wages that are subject to FUTA taxes as well. Now, the nature of those wages and income are pretty much the same. And by that, I mean wages, bonuses, commissions, all of that kind of stuff pretty much is going to be the same as what we discussed for the other taxes. Now, the difference with FUTA is, though, we have a wage base. So just like Social Security taxes have a wage base, that $147,000, FUTA taxes have a wage base. It's much lower. It's $7,000. So only the first $7,000 of wages are subject to FUTA tax. Now, that's different from SUTA tax. When we start talking about SUTA taxes, you'll see that it varies from state to state what that wage base is. But for FUTA taxes, it's only going to be the first $7,000 of wages. Now, unlike Social Security taxes, where each individual has that wage base of 147,000. So it doesn't matter how many employers they had all together, if they made 147,000 or more than that, any wages beyond that, they're not subject to Social Security taxes on. With FUTA taxes, however, because it is a tax that's only assessed to the employer, it is on a per employer basis, meaning that if you have multiple jobs, if you have 5 different employers, each of those employers has that $7,000 wage base. So if you made $7,000 at 5 employers, you made $35,000. If it was equal, the 7,000 at each of them, the entire $35,000 of your wages is going to be subject to FUTA taxes, because each employer had a $7,000 obligation, $7,000 wage base. Does that make sense? Okay, you're looking confused. So what?
No,
No,
so
okay.
it's for the just employer?
It's the employer, right. So only the employer pays FUTA taxes. Employee does not have any portion, any responsibility for FUTA taxes.
And the SUTA is for both?
SUTA can be a little bit different. It varies from state to state, what the rules are. And we'll get to, we'll talk a little bit more about that. So SUTA can be a little bit more complicated than FUTA, because you've got different tax rates, also called contribution rates. You've got different wage bases based upon the state as well. So you've got a lot of different, kind of some different factors involved with the SUTA. But for FUTA, like I said, it's only, and with SUTA, some states require employees to kick in. Some states don't require employees to kick in. So it varies from state to state and from employer to employer. But for FUTA, it's the same across the board. $7,000 wage base. If the wages are subject to FUTA taxes, then the employer is going to have to pay taxes on that first $7,000. Once they reach that $7,000, they don't have to pay for that employee. They don't have to pay FUTA taxes anymore. Does that make sense there? So again, it's just a list of the types of income that would be subject to FUTA taxes. This is not an exclusive list. They've got a longer list in your book. I'm not going to go through all of it. Like I said, for the most part, it's the same type of income that was subject to federal income taxes and Social Security and Medicare taxes. So again, regular wages, bonuses, advances, retroactive wage increases. So if you received, if you made, an employee made $8 an hour, and in July, the employer decides that they should have been making $10 an hour, and then they go back and pay them all that as though they had made that extra $2 an hour. That's subject to FUTA as well. Tips that are reported by the employee to the employer, certain stock payments. Sometimes employees will receive stock as a type of like bonus or commission. That would be subject to FUTA taxes. And as it says here, if the employee has more than one employer in a year, that wage base applies separately to each of those employers. Okay, so each employer has to pay that. So types of wages that would not be taxable, any advances or reimbursement for business expenses. So like that mileage that we had talked about, that's not subject, that's not wages, right? And so it's not subject to FUTA tax. Advances, until those wages are actually earned by the employee, the advances would not be subject to FUTA tax. The employee might have to pay those back, right? Any retirement pay is not subject to FUTA. Educational assistance from the employer to the employee is not taxable. Again, employers benefit with regard to meals and lodging if it's the employer's benefit. then it's not subject to FUTA taxes. If it's for the employee's benefit, then it would be subject to it. Strike benefits, and again, there's a full list of wages that would not be subject to FUTA taxes. The big thing to remember with that, though, is that $7,000 wage base, okay? Okay, so we've got the base, and I think we talked about early in the class that any tax has two components to it. There's a rate. What percentage are you charging? And then there's a base. What exactly are you taxing, right? What's the amount that you're taxing? So that 7,000 is the wage base. 6% is the tax rate. Now, 6% is the full tax rate. I think I had mentioned last week that we're going to talk about, we're going to cover this credit, and the credit reduces that. No, sorry. The credit reduces that tax rate. Okay. If employers are entitled to the full credit is 5.4%. So your tax rate, your full FUTA tax rate is 6%. Full credit is 5.4%, which brings the tax rate down to 0.6%. Okay. Most employers are entitled to that full credit. The vast majority of employers will be taxed at 0.6%. So if they've got an employee, and you'll become familiar with this amount because it's very common in your homework problems, well, and in practice. So 0.6% times $7,000 is $42. That would be per employee per year. So it's fairly small amount. Of course, if you have 10,000 employees, that certainly adds up. But it's for most employers, that's the amount that that's the most they're going to pay for any employee. If the employee makes $1 million a year, it's still just that based on that $7,000, right? So, and again, it starts over each year. So that would be on that's an annual basis, right? Now, like I said, most employers do receive that full credit against the tax, but some employers don't. Sometimes that credit can be reduced. And this is where it gets a little bit confusing, the wording of it. When you think about a credit being reduced, it results in a higher tax. So even though we're using the word reduce with regard to taxes, and it can kind of be tricky to keep that in mind. If the credit is being reduced, that means the tax rate is going up, okay? Which means more tax is going to be paid. So a reduction of the credit is like a penalty to the employer. Something has occurred that has caused them to lose the benefit of that full credit. And there are a couple things that can happen to cause that to happen. One is the employer hasn't paid all of their state, or they weren't on time with payments of their state unemployment taxes. Now, I had mentioned early on that FUTA and SUTA work in conjunction with each other. Sometimes states aren't able to meet all of their obligations with regard to paying benefits. They still have to pay benefits. So what they do is they have to call on the federal government to help out. So the federal government is going to penalize, is going to penalize employers and states for doing that, right? So the first case is if you are an employer and you are late on your state unemployment taxes, you're going to start to lose some of that credit. That's to encourage you to pay your state unemployment taxes on time, right? You don't want to lose that credit. The second way that that credit can be reduced is if you are in a state that has borrowed money from the federal government for unemployment, and you are, well, if you've borrowed it until you pay it back, everybody in the state is going to be subject to a reduced credit. Again, reduced credit means tax goes up. Okay, so those are the two ways that this could be affected. This credit could be reduced. So you can see if we've reduced the credit, let's just say you've lost 0.4%. Well, now your tax rate is 1%. That means that this has gone up to $70 per employee. Okay. It could be that you don't have any credit, which means that for each employee, you're going to pay 6%, and now we're talking about $420 per employee, right? That would be $420. So when that's gone down to zero. So I'm kind of driving this home because I find that this is one of the concepts that students struggle with, is this understanding how this credit works and the reduction of the credit. So if all is good, you've met all of your state unemployment obligations, and you're not in a state that owes unemployment, that doesn't owe anything to the federal government with regard to unemployment, cool, you get the 0.6% tax rate. If, however, you are being penalized because you've not followed those guidelines, or you happen to have the unfortunate circumstance of being in a state that is in arrears, then that tax rate is going to go up. Now, the only state in recent history, and I don't know what the status is right now, can anybody guess what do you think, which state do you think has had its credit reduced in recent history? It doesn't happen very often, but in recent history. Any guesses? Yeah, yep, Tammy has it, California. California has been in financial straits. Now, I think last I knew anyway, they were up to date on it. But yeah, did somebody raise their hand? Yeah, Lisa.
So if a large company wants to get a loan or whatever on it and doesn't pay their taxes, then all the other large companies plus the small companies, businesses would not have.
No, so like I said, there are two ways that this rate can be reduced. One is on a per company basis. That's if the company itself is late on paying its state unemployment tax.
Right.
So then it would only apply to the company, that particular company. Or if the state itself is late, or it like owes funds to the federal unemployment agency because they borrowed funds, and they're late, and then everybody in the entire state would be subject to that credit reduction. But if it's on a per company basis, it only applies to that company, that they would have an adjusted rate. Does that make sense? Yeah, other companies are not going to be punished for the sins of a single company. But every company will be punished for the sins of the state.
And right now, all the states are.
As far as I know, right now, yeah, that everybody's up to date. But California was like I said, it doesn't happen very often on a statewide basis. But on a company by company basis, it will happen because companies will be late on their state unemployment. Okay. So questions about that credit and how that works. Okay. So, and this basically says the same thing as what I just went through. So to get that full credit, the employer must have made their SUTA contributions on or before the due date for filing their SUTA taxes, right? If they're late on their FUTA taxes, they're going to get penalties assessed by the IRS, but they're not going to be due. It's not going to affect their credit. We're talking about the SUTA taxes. If a contribution is not made on a timely basis, then the credit is limited to 90% of the tax. So the credit, and that's a little bit, so think about 90% of the tax. So here's the tax rate. So 90% of that, what's 6 times 5? Well, I can't do it on my head. So 0.9 times 6. So 5 point, well, that's the 5.4%. So sorry. So that's the maximum amount. It's going to be any amount less than that. Even if the employer pays into more than one state unemployment compensation fund, the credit against the federal tax is still limited to 5.4%. So it will affect, remember, FUTA is assessed on a nationwide basis, federal basis. So if you're late, say you've got operations in Illinois and in Iowa, you're late on your SUTA taxes in Iowa, but you paid them on time in Illinois, that credit is still going to be reduced for all of your employees, even the ones that are in Illinois, even though you were on time for your paying your SUTA taxes. Does that make sense? Kathy?
But why is that?
Because FUTA taxes they apply on the rate and the base applies on all of your operations in the country. Or if you're subject to FUTA taxes, then it applies to all of your employees that are operating in the US. Or it could be foreign as well if it's a US company. So whereas with SUTA taxes, it's on a state-by-state basis. Does that answer your question? Okay. States, and here they're talking about SUTA taxes. So some states have a higher wage base than the federal amount. In fact, most states have at least a different wage base than the federal. And their tax rates are different for the most part. Their tax rates, which they call contribution rates, it is like a tax rate, but the contribution rates are applied on a company by company, industry by industry basis. And we'll talk a little bit about why that is here in a minute. Okay, so for FUTA tax, it's you've got that one wage base and you've got that one tax rate. Okay, doesn't matter how much utilization there is of unemployment benefits. Questions? No. Okay. Yeah, employers should not be located in a state that defaults on its repayment of advances, that Title 12 advances, which refers to those unemployment benefits. So if they have if they have the misfortune of being a state that's in default, like I said, everybody in the state has to pay for the sins of the state. Let's see. Credit is reduced 0.3% per year beginning the second year after the advance. So if it hasn't been paid back after that, within the first year, then that 0.3%, remember a full credit is 5.4. This will be reduced though by 0.3% per year that it's late. So in the first year, this would be reduced then to 5.1. The next year, it's going to be reduced to 4.8, which means a tax rate is going to go up. Okay. Additional credit reductions are possible beginning with the third or fourth consecutive year in which the federal loan is not repaid as well. Questions? Okay, SUDA. Now I actually want to pull up your book because your book has a listing. Oops, get out of here, of the different rates in the different states. Different rates for different states. I can find, sorry. There we go. I get too many windows open here and I can't remember where to go. Okay, so let's look in the textbook. All right. All right, so this is kind of hard to see in the ebook, but each of the states is listed in this chart that is in your textbook. So again, this would be for 2022. These amounts are going to change every year. States are going to usually that their wage base usually goes up every year. Now they have on this table, we've got the state on the left. The let's see, this is the indication of who is, when they are subject to the taxes. So size of the firm, one employee within a, like for Alabama, a 20-week period, or they've got the size of the payroll. So in California, any employer with a payroll over $100 in any calendar quarter. Well, that's a pretty small amount, so probably most of those companies are going to have that. Contribution rates. Now, again, contribution rate equals tax rate. We don't really, I mean, I will use the term tax rate. It is like a tax rate, but it's not like a tax rate in that it's based on the industry that the company operates in, and it's based on the utilization of benefits by former employees of that company. Again, it's like insurance. The more you use it, the more expensive it gets, right? So if an employer happens to be in an industry that has a high turnover rate, their contribution rate or tax rate is going to be higher just because they operate in that industry. Great example of that is the construction industry. Construction industry has a really high turnover rate. First off, it's also very seasonal. And when employees aren't working during certain seasons, they may apply for unemployment benefits. So that works against the employers, and just by nature of that industry, they're going to have a higher contribution or tax rate. The accounting field has a pretty low turnover rate. And so if you have a CPA firm, the employees that work for your CPA firm probably don't, you're not seeing a whole lot of, they're not quitting as often as those maybe in the construction industry or in the restaurant industry. That would be another one with a higher turnover rate. therefore a higher utilization of unemployment benefits. The accounting industry would have, those firms would have lower contribution rates. Okay, so they're going to pay less in SUTA taxes. On this chart, they tell you what the range is of those rates. So you can see there can be a pretty wide range. Alabama, which was the first one, I know it's hard to see here. Alabama, so ranges from as low as 0.65% for their contribution for tax rate, up to 6.8%. And for Alabama, it's on the first $8,000 of income. So you can see here, you have to do two different calculations for these taxes. And this is, your problems will require this. You have to do one calculation of the tax at the federal level, and then you got to do an entirely different calculation at the state level, right? Because you got a different rate and you got a different base. For some of these others, let's see, I can't see which state this is. So Arkansas, that's a pretty large range. This is Arkansas here. Starts at 0.3% tax rate, goes up to 14.2% tax rate. That's a lot. That's a really high tax rate. Imagine if you've got $1 million in wages, in FUTA wages, which, I mean, wouldn't be, it's like for a even small to mid-sized company, that wouldn't be out of the realm of possibility. 14.2% on that, $142,000 for SUTA taxes. This one, look, I don't know who that is, but it goes up to 20.93%. SUTA taxes are, that's Arizona. Is that Arizona? It's Arizona. 20.93%. That's substantial. Iowa, let's take a look at Iowa here. So Iowa, lowest rate is 0. That's nice. That's the best tax rate you can get. They don't tend to do negative tax. Well, we have like earned income credits, refundable credits, where you can't have a negative tax rate. So Iowa ranges from 0% to 7.5%, but it's on the first $34,800 of wages for each employee. So you can see that wage base is quite large, even though the rate is smaller, right? Let's see. So on this as well, there is a column for the employer. So these are the taxes that the employer has to pay. And there's a column for employees. As I had mentioned, there are some states that do require employees to contribute to the unemployment taxes. This one, Alaska. So the employer base is anywhere from, rate is anywhere from 1% to 5.4%. The base is 45,200. The employee, the rate is a flat 0.56%, so it's not a range, on, again, the first 45,200. Okay, so in Alaska, they actually do have the employee contributing. It looks like in California, of course, California as well has an employee portion. But most states, if you go down, most states don't have an employee contribution. Iowa does not have an employee contribution. So it's only the employer that pays that tax.
Still FUTA, right?
Sorry?
Is it still FUTA?
For SUTA.
SUTA, that's SUTA.
Yes, this is for SUTA. Since it's on a state-by-state basis, it differs from state to state, it's SUTA.
Okay.
Yeah. Some of these states, so Hawaii, it's not really an unemployment tax. They've included in here disability insurance, because there are some states that also require employees contribute to a state disability fund. So if you become disabled, though, then you're entitled to certain bits. It's going to vary from state to state who gets those benefits. But that's what they're talking about here. I think this was Hawaii, did I say? Yeah, Hawaii. 5.5% of maximum weekly wages of $1,200.30, not to exceed $6 per week for disability insurance. So maximum $6 a week that the employees are going to contribute. But they've got, I think Pennsylvania is another one, and you'll see there's New Jersey. New Jersey has an employee part. They've got a couple here. So disability insurance and unemployment insurance that the employee has to contribute to. Pennsylvania as well. I think some of your homework for chapter 4, when you fill out your W-2s in that homework, there is, it's in Pennsylvania, and they reference Pennsylvania unemployment insurance. You have to put on the W-2. So there's, yeah, so 1.3% on the first 81,500 in disability insurance. Oh no, that's Rhode Island, sorry. Pennsylvania's up here. 0.06, I'm sorry, 0.06% on total wages for Pennsylvania. So you've got to, when you're doing your problems, make sure you've got the right state. You're going to want to reference this table. Okay. Your problems, I don't think your problems say, I don't know that anybody's in Iowa. So it may vary from, you know, you might have somebody in Montana, and then the next problem, New Jersey. Just make sure you're on the right state, because that is going to affect your answers there. Let's see. So these columns, yeah, go ahead.
I'm sorry, what page is that that on in the book?
That's a good question. Well, it's figure 5.1, whatever page. I don't have, on the ebook, it doesn't really have pages on it.
Okay, but in the 5.5-2B.
Yeah, under tax rates SUDA.
Section. All right, thanks.
Yep, you are welcome. The right-hand columns of this table, I wish you could actually make this table full size. The right-hand columns here talk about the benefits in each of the states. So you're not, I don't think you have any problems that require you to look up what benefits are. For payroll, the payroll professional, it doesn't really matter what the benefits are. We're concerned with collecting the tax and making sure we collect it and remit it and file the correct reports. The benefits, once somebody's receiving benefits, they're not an employee anymore. So they're really not our problem anymore, right? But just for your information purposes. So the first column here is waiting period. So is there a waiting period for receiving benefits? Once you become unemployed, and it's determined that you are entitled to those benefits, is there a waiting period? Some states have like a week waiting period, some have 0. I don't know if there's any that are more than a week. Seems to be one or none. And then there is a statewide maximum amount of benefits per week and a minimum amount per week. And then the last column is how many weeks can you get? What's the maximum number of weeks you can receive those benefits? So Iowa, take a look at Iowa here. Here's Iowa, the blue. There's no waiting period. The maximum amount of unemployment benefits is $531, and it's going to be based on what your wages were, okay, at the job. Minimum $79 for a maximum of 26 weeks, half a year, 6 months. You'll see actually 531 is pretty generous, relatively speaking. Here's 648, that's Hawaii. Think about the cost of living in Hawaii versus the cost of living in Iowa. It's kind of surprising that Iowa is as high as it is. Let's see, 795, Massachusetts would be the maximum. 693, Minnesota. There's a 731, New Jersey. Some of the stingier states, so 133 is the maximum in, whoops, come back. Puerto Rico. Got Puerto Rico in that too. Anybody else? Oh, here's a 929. Who's that? Washington State. So if you're going to be unemployed, do it in Washington State.
What if I move to Washington, I get the unemployment thing, and then I move to Iowa?
And then you move to Iowa? I don't know, but how that works.
I will get the,
I don't know what I don't know if you're required to stay in the state. You might be. I said, I don't know much about the benefits, how the benefits work. But, you know, Iowa's on I mean, it's not the highest, obviously, but it's on the higher end of those benefits. Most of the states, some of them, so 23 weeks, 26 weeks. I think I saw 20 somewhere. During COVID, this was different. During COVID, like I had mentioned, the federal government doesn't provide benefits. They just administer the program. So those taxes that are being collected are to pay the people who enforce it, essentially the program and run the program. But during COVID, we had an exception. The federal government did kick in an amount of benefits, and I don't think they had any. I think it was just a flat amount that you could receive, and that was on top of state benefits. Okay, but that was an exception that has ended as well. The duration was extended. So here's this is kind of a good, I don't know if I can make this any bigger, probably not. So here's an example. If you had, so you need to know what state the employee is in, right? And what that contribution rate is. So here we've got a company that has FUTA taxable payroll. So this is for the entire company of $215,600, SUTA taxable payroll of $255,700. So the taxable base is different because that wage base is different per employee, right? So these two numbers most likely aren't going to be the same. So in order to calculate that, you've got to take the $215,600 times the FUTA rate. Now we're assuming that they get the full credit, okay? So $215,600 times 0.006 or 0.6%. Their FUTA taxes, $1,293.60. SUTA taxes, because their tax rate is much higher for SUTA purposes, and their base is higher, $255,700 times the 5.6%, they're paying $14,319.20 in SUTA taxes. Makes sense though, because that is where the benefits come from. All right, remember, this is just to pay salaries of people who administer it. Yeah.
Is this like a yearly?
This is an example of yearly. Yes, it could be monthly though. I mean, the company could be paying, if they paid that much and had, you know, this much in taxable wages in a month, that might be how much they're going to owe for that month, or quarterly, right?
what happened with the 7,000 wage base?
Well, that is included in here in the FUTA amount. So that means they've got several employees, right? So, and remember, it's up to 7,000. So we really can't tell by this number how many employees they have. Because you could have employees, you can have wages in there for employees that made $1,000. Wages for employees that made $6,000, $7,000, you know, any amount up to $7,000 would be included in that on a per employee. Okay. We'll do some problems here too. Okay. So you're gonna wanna bookmark that page that has your, that table in there. Okay. We already talked about that. So let's do an example here. We've got Sumatra Imports. They're in New Mexico. All right. Well, New Mexico, and I suppose I just closed my page here. Oh, no, I didn't. So you're going to want to pull up New Mexico and have that handy. Okay, so here's New Mexico. So it's anywhere from 0.33 cents to 6.4% on the first 28,700 wages. Cool. Where's my, oh, here we go. Okay. So they have a SUTA tax rate of 4.2% with a taxable SUTA wage base of 28,700 for each employee's earnings. Again, that wage base is going to be based on annual earnings. So if you have an employee that made $29,000 in the first month, for the entire year, the 28,700 is what's going to be, they're going to pay tax on that 28,700 in that will be due in that first month. But the rest of the year, that employee, there's going to be no taxes, no SUTA taxes applied to them, right? Because they're already above that wage base. So during the year, Sumatra had FUTA taxable wages of 109,500. SUTA taxable wages were 298,700. So you can see kind of the difference here because this FUTA is based on the first 7,000, whereas the SUTA is based on the first 28,700. So those SUTA wages are most likely going to be higher. So FUTA, we're going to take the 109,500 times the tax rate, again, assuming they are not located in a state with a reduced credit. So their tax rate is 0.006% times that 109,500, $657 in FUTA taxes. 298,700 times 4.2%, 12,545.40 for SUTA taxes. Now, when you're doing the calculation, you have to, this is pretty easy because they've given you the totals. They've told you how much is taxable. In reality, you're not going, obviously, you're going to have to figure out how much is taxable, how much were the taxable wages. So you've got to figure out on an employee by employee basis. So if we had a company, let's just say, I'm going to do this by quarter. Okay, we've got quarter 1, 2, 3, 4. And we've got 5 employees. 2, 3, 4, 5. These are our employees. In the first quarter, employee 1 made $6,000. Employee 2, $9,000. 5,000, 1,000, and 10,000. Okay, let's say we're in Iowa, which we are. Pretend for a moment you're in Iowa. So the Iowa wage base, does anybody remember what that was, what I pulled up? Let's see.
34, like 38.
Yeah. There we go. Yeah, 34,800. So we're in Iowa. 4,800. And say we've got a tax rate of 6%. Okay, it's going to be anywhere from 0 to 7.5%. The state unemployment, the workforce development is what is called in Iowa. They tell the employer what their rate is. Okay, so let's just say it's 6%. All right. Actually, let's make this a little bit shorter. Let's just do the first two quarters of the year. We'll do another 6,000, another 9,000, 2,000, actually, I might want to do more. Let's see. Let's say this one got 42,000. I got a bonus. And another 1,000. All right. So our total wages, we're going to have wages that are subject to FUTA and wages that are subject to SUTA. Let me see if you guys can see that. Pan over a little bit. Right? So we need our total. All right. So we add those together. We've got total wages of 12,000, 18,000, 7,000, 2,000, and 52,000. All right. So for each of these employees, tell me how much of their wages are subject to FUTA tax? What about employee 1?
Yeah, 5.
5?
Yeah,
Why 5?
you can take 12 minus 7,000.
But it's only 7, the most, but it's, I think you're thinking of it backwards though. You're thinking that the amount that is not going to be subject to FUTA tax. The amount that is going to be subject to FUTA tax is 7, right? How much is subject to SUTA tax?
12,000.
Yeah, all of it. Because remember, it's up to 34,800. What about this employee? How much is subject to FUTA?
7,000.
7,000. How much is subject to SUTA?
18,000.
18,000. What about this employee, employee 3?
All 7.
7.
7 too.
Employee 4. Others can answer too. I'm sorry?
2,000.
2,000, right. SUTA?
Same.
Yeah. What about employee 5? 7. SUTA?
34.
Right, 34,800. So in total, let's add those up, figure out how much tax we have. All right, so we've got 30,000, I can do that one in my head. 30,000 of FUTA wages and SUTA wages, 12, 30, 7, 8, 9, 39 plus 8, whoops, 39. Do that right, 73,8? You can check my math for me. This, I didn't put the FUTA, you know what the FUTA rate is. We'll assume that they get the full credit. So this is going to be times 0.006. Be careful. So just like that additional Medicare tax, 0.009. And this is going to be times 6. Whoops, 0.06. So 30,000, 180. They're going to pay $180 in FUTA taxes. 73,800 times 0.06, 4428 in SUTA taxes. So you have to do each of those separately. You cannot assume that it's going to be the same wage base. or this, I mean, it's probably not gonna be the same wage base. Although there are some states, I think, in here that do have the same wage base. So 7,000, who has it? Not very many. Here's one. Oh, it's 7,700. 1595, 11. No, I don't see any right now. There have been in the past. Obviously, there are two ways to raise revenue. One is you could increase the base. The other is you can increase the rate. Right?
So in the next period, only the.
Right, so let's go to the third. Let's go to the third. Well, actually, let's do this. Let's look at the first quarter. Let's do it by quarter. Sorry, I know that's going to be hard to see. So we know what the total is for both of those. All right, so quarter one, 6,000, right? 7,000, 5,000, 1,000, 7,000. All right, so in the second quarter, how much of this 6,000 is going to be subject to tax? One, right? Everybody see why? Because they already had 6,000 subject to it in the first quarter. How much of the 9,000?
0.
0. How much of the 2,000? All of it. All of it. How much of the 42? None. Right. So the amount of, so what are we at? 13, 14, 19, 26,000 here. And this is just for FUTA, right? And 4,000 here. Right. So in the next period, in the third quarter, will employee one have any wages subject to FUTA? Nope, they've already absorbed their 7,000, right? Employee two won't either, neither will employee three. The only one that's going to be subject, who's going to have wages subject to FUTA is employee four. But for SUTA purposes, all of these are going to have wages subject to SUTA except employee five, right? FUTA taxes are paid on a quarterly basis. Well, no, let me step back. If the total owed doesn't exceed $500, you can pay it annually. And it's due January 31st, I believe, along with the form. If, however, once you get to the point where this exceeds 500, then the employer has to send the payment in. Now, for us, if we assume it was the same, they're not going to have to pay. They can just pay it at the end of the year, right? So they're not going to reach $500. But well, let's make this a little bit more interesting here. So, well, no, 7, they're never going to get to, unless they had a bunch of other employees. Let me use a different example. Can I erase this? Can I erase this? Okay. Let's forget about the wages right now and just assume liability. FUTA taxes for quarter 1, 2, 3, 4. And we've got FUTA liability here. So in the first quarter, we'll have $180 of liability. Second quarter, 300. Third quarter, 400. Fourth quarter, 100. All right, in the first quarter, we don't have to send anything in. We haven't reached a cumulative $500 owing, right? In the second, so we'll do cumulative here. So cumulative is 180. Second quarter, our cumulative is 480. We still don't have to send anything in. Third quarter, however, now we're up to 880. We need to send all of that in because we're over 500. Fourth quarter, we're going to have to send them in another $100. Make sense? So once you reach $500 of liability, then you have to send it in on a quarterly basis. Or yeah, it's on a quarterly basis. You've got to send that in. Okay, but if you never reach 500, you can just pay it at the end of the year by January 31st. All right. All right. Don't need to do that. Did we already go over this? So what happens when you're a new employer? So your rate, like I said, your rate is going to be based on two factors. One, the industry that you operate in. And then there's going to be a range within that industry of what you, of the rate that you pay. That tax base applies to every employer. It doesn't matter what the industry is in the state. I lost my train of thought. Okay. So the rate though, based on industry, it's also based on utilization. What I mean by utilization is how many of your employees have extracted money from the unemployment fund, right? The more you have employees or former employees drawing benefits, the higher your contribution rate is going to be, right? Because again, just like insurance, the more you use it, the higher your rate is going to be. They call that a pool fund, which is what they're talking about here, the first sentence. All states have enacted pool fund laws. The cost of unemployment benefits are spread amongst all employers in a state. So just like health insurance as well, if you happen to be somebody who uses a lot of health insurance, more than what your premiums are, then those funds are being drawn from others who use less. Same with car insurance and all of that. Now with health insurance, they used to be able to adjust your premium based upon your utilization. They don't do that anymore. They're not able to do that anymore. But that's how the unemployment works. So if you're a new employer, you know what industry you're in, but you don't have any utilization rate, right? You don't have any employees. So states will give you an initial contribution rate. And then as you go forward, if there's any utilization, then that rate is going to be adjusted upward. If there's no utilization, in Iowa anyway, it could be zero. Now there are certain industries where that's just not going to be the case. You're not going to get to a zero rate, but certain industries where no tax is due, no unemployment tax. That's what they're talking about here with that experience rating based upon that utilization, based upon that past experience. And we talked about, so some states have have employees that have to contribute as well. We saw those. Iowa's not one of them. So let's see what else. already talked about a lot of this. So lower employee turnover is reflected in a lower unemployment tax rate. They use what this is called this reserve ratio formula. This was the most common formula. What the reserve is, how much, they'll look at how much you've contributed as an employer versus how much has been drawn out. If you get into negative territory, so let's say you've contributed to $14,000 worth of unemployment premiums, but $20,000 has been withdrawn by employees, well, now you're $6,000 in the hole. You got to make that up. What they're going to do is increase your rate to make that up, right? So contributions minus the benefits paid divided by the average payroll over the year results in what we call the reserve ratio. Then you compute the total reserve, let's see, built up employer contributions ratio, let's see, positive balance. Okay, so if this reserve ratio is positive, then you get a lower tax rate. If it's negative, you're going to get a higher tax rate applied to you, okay? So, for example, let's play around with this a little bit. And what you do is you apply that ratio, then you've got some problems in your homework concerning this. You apply the ratio to a table, and then that is the tax rate that is used, okay? In fact, let me see, we've got 10 minutes. Let me see if I can find that problem so we can actually do it. I don't get it exactly right. 5. Oh my goodness, let me see if I can find. Probably gonna be further down. No. Here we go. Okay. Carlton Software Company enables employers to reduce their contribution rates under the experience. Okay. From 2009 to 2018, the company's total contributions to state unemployment compensation amounted to $14,730 for the calendar years 2019 to 2022, inclusive. So their total contributions during those years. Contribution rate was 2.7%. The contributions of each employer are credited to an account maintained by the State Unemployment Compensation Commission. This account is credited with contributions paid and is charged with unemployment benefits that are paid, withdrawn from the account. Starting January 1st, 2023, the contribution rate for all employers will be based on the following tax rate schedule. So you have to calculate what the reserve ratio is and where it falls, and then you can look up what the corresponding contribution rate is. Annual payroll for calculation purposes is the total wages payable during a 12-month period ending with the last day of the third quarter, any calendar year. So it would start with your first, when you're calculating the average, you're going to start with the fourth quarter, rather than, you're not doing like first, second, third, fourth and figuring the average. You're going to start with the fourth quarter, at least for this problem. Okay. The average annual payroll is the average of the last 3 annual payrolls. So this is why they gave you multiple years there. Student tax rate for the year is computed using the information available as of September 30th. Schedule below shows the total payroll and the taxable payroll for the calendar years 2009 to 2022. So again, annual payroll is the total wages payable. So total payroll, not the taxable payroll, but the total payroll. So unemployment benefits became payable to the company's qualified unemployed workers on January 1st, 2009. Between then, total benefits amounting to $14,997.40 were charged against the employer's account. So they want you to figure out what the contribution rate is for 2023. So if we look back at so we have to figure out that reserve ratio. Contributions minus benefits paid divided by average payroll. So we got to look at the problem for our, let me write that down. Contributions minus benefits divided by average payroll. Okay, so I think they gave us the contributions and they gave us the benefits, correct? Let's see. Okay, so company's total contributions, $14,730 minus benefits, $14,997.40. All right, so we're going to come up with a negative number here, which means we're going to have to pay more than what we were paying. So 14. $14,997.40. So $267.40. Okay, we're going to multiply or divide this by our average payroll. Now it's based on the last 3 payrolls, and it begins in the fourth quarter. So let's see, last 3 years. All right, so, and it's based on the total payroll. So like the last 2022, we're gonna add 14,190, 99.90, 93.30, 93.40, and then divide, right? So that's 1 year. And then we're gonna take the next year's 12, 12, 13 plus 12,570. And then the third year, 13,190, 11,30, 11,570, 12,670. That makes sense? And then we're gonna, so add each of those up and then divide it by 3 for our 3 years. So, oops, doesn't help when so 14,190 plus so this is 42,850. Year 3, year 2. will be 70 plus. Everybody see where I'm getting these numbers? It's from this column here, starting 1, 2, 3, 4. Those are the ones we add together. So 50, 430. And then the first year, move this out of the way, whoops. So 30 plus 48, 460. Okay, and then we're going to add all those together, plus 50, 430. 42, 850. Somebody just chimed in. Oh, that's okay, Julie, go ahead. I know, I run long, sorry. So 140, 740 divided by 3. Oops. 47, 246, 67. So 47, 246, 67. Oops. So 267. Oh, 5. So 0.5 or 0.6. Do I have this right? So contributions falling below. Well, this one is, let's see, contributions. Zero to 7.9. I think it's 5.5. Did I get that right? Or let's see. We'll see. You guys have seen me mess up many times. Nope. All right. So let's look down here. Yes. If additional benefits were just, oh, they're not giving me that. All right. Or charged against the employer's account. I used the right numbers, didn't I? They said contribution freedom. Where did I see that? If you guys have to leave too, I know I'm over, but I want to see where I messed up here. I'm sorry, I read something and I can't find it again.
Shouldn't it just be the 7%, since it just says contributions falling below benefits paid?
I'm sorry, I'm looking for something that I can't find again.
Annual payroll for calculation purposes, total wages payable during a 12-month period. So it's total wages paid, which total payroll, I use that column. Am I reading that right? So total wages payable during the 12-month period with the last day of the third quarter of any calendar year. I'm using this column benefits, that's right, unemployment benefits. $14,997.40, $14,730. Well, let me use the. Are you also using the taxable payroll?
Well, I wasn't using the taxable payroll. I was using the total because the wording was total wages payable. Average of last 3. Okay, I need a hint. Let's see here. Sorry, this is too big now. This is number, what am I working on here? Number 53? Hold on just a second. I'm gonna go back. Just give me a sec. It's 4.5. Okay, so here's the calculation. Oh, okay, fine. Sorry. All right, so they gave me, so for the calendar year 2019 to 2022, the contribution rate was, so from 2019 to 2018, their contributions were 14,620. For 2019 to 2022, they had a 2.7% rate. So we have to calculate what the additional taxes were that they paid. I was just looking at, I zoomed past the 2018. I zoomed past that. So we're going to take 2019 to 2022 contribution rate was 2.7%. So, and these are for those years, except we've got to calculate based on the taxable payroll. Because this is what we're calculating is the additional amounts that they would have contributed into their fund. They only gave us what was sitting in the fund at this point, or at this point. Now we've got to calculate, okay, so how much additional did they put into the fund? We do that by adding taking the taxable payroll amounts starting here through the end and multiplying that by 2.7%. So, which is what they did here. So you can see, so 560, did I miss it? I got 460. All right, I might have missed one. 46,790. Where's the 46,790? Oh, yes, they are. Okay. 46,790, 51,760. Yeah.
So all of the amounts the additional amounts that would have been contributed are added there. So they actually have a positive reserve. Total reserve is, so they've got 19,362.82. In this case, they paid benefits of 15,011. This is a different problem, different numbers. But we would have subtracted that, right? So their balance in their reserve account is 43,5172. Then we take the average payrolls, which they have different numbers. So the average is going to be different. Ours was that. Their average, so in this case, 141, it's close, 141,750. Sorry. Divided by 3. In their case, it equals 47. I'm sorry, no, that's really tiny. 47,106.67. So this is 9.24%. So when you take so they've got the 47, and when you take the reserve amount of 43.52 minus 47,106.67 divided by, when you take that divided by the 47,106.67, you get 9.24%. And then you go up here to the table. Where does 9.24% fall? It's on 4.5. Okay. Sorry, that was, again, I'm reading too fast, even though I'm sitting here trying to. So make sure you add all of the contributions up. So you're adding, what they had before, and then add what they added to the fund. Does that make sense? Okay. Oh, nobody's left.